In the last two videos, I've been talking specifically about dynamic trading. I explained what it is and why I firmly believe you should learn to trade dynamically because, in a nutshell, dynamic trading adapts to market conditions on the fly. It does so on its own automatically. In yesterday's video, I addressed that you should base your analysis on a closed candle, not on a current live candle, although that is what most traders, exactly what most traders do. And I explained the reason behind why you should always focus your analysis on closed candles, even though it seems to make more sense to base it on a live candle. If you haven't watched either video, I urge you, please go and check them so you know what I'm talking about. Hi, this is Lode with Black Bear Dog Trading, and welcome to my YouTube channel. If you're new here, I invite you, come on in, and if you're recurring, thank you for staying loyal to my channel. I really appreciate it. So now that you know about dynamic trading, the question comes to mind: what strategy is out there that you can use, that you can dynamically trade with? Must be a custom-made program, piece of software, must be a custom-made indicator or EA, expert advisor, or something to that effect, right? No, it's not. All the tools we're going to use for our dynamic strategy is all based on the fold standard indicators, oscillators that already come with the trading platform, regardless of the trading platform that you're using. So I'm going to spread this out over several videos, and with each video we're going to get more and more technical and more advanced. So please make sure you watch all the videos in order, or you may not be able to follow along depending on your expertise of trading thus far. So let's get started here. What I have in front of me here now is nothing more but a chart with the Euro USD. I've set it to 1 minute only because so you actually see price move and you see what's going on, while if I trade my normal time frame, which is 30 minutes, price would move a lot slower and I wouldn't be able to relate to you exactly why I do what I do, and you wouldn't see price react to it either. It would take too long. So this is just a plain chart. There is this is MetaTrader 4, but again, you can use any platform for this. There is nothing on this chart but price. Just for simplicity reasons, I've chosen bars, but normally I trade actual bars like this. And however, we'll stick with candlesticks for now because that seems to be the most common analyzed chart pattern used by most retail traders. So that's it. This is a 1 minute Euro USD chart. And by the way, this applies to all currency pairs regardless of the one you prefer to trade. This is nothing but price. We start with a total blank chart. The next thing we do now is we're going to add a moving average. In particularly, we're going to add the 50 exponential moving average based on close. So you do that however you do that on your specific trading platform. On MT4, it goes like this. I click on the indicators lists. I choose moving average. I set this to 50. Shift stays 0. We choose exponential. We apply it to close. And we choose a color, whichever you prefer, and a thickness of line. And we click on OK. And we're set. Now, the premise of a moving average being dynamic may not be 100% in line with what you know about trading, but the fact of the matter is moving average indicator is a dynamic indicator for the simple reason that it automatically adjusts itself based on price data. The moving average will curl up, will curl down, will curl sideways on its own based on price data, not just on the current bar, which is the live bar, but on the prior bars. So while the moving average is considered a lagging indicator, which is partially true, it is, however, a dynamic indicator. It adjusts automatically to price movement, reflecting the price that is happening in the market. Now, the 50 is a very standard short-term moving average that is used by professional traders alike. Usually the 50 or the 100 are considered quote-unquote standard moving averages that you can actually base your analysis on, market analysis on. And the premise of this moving average is very simple. If you are above the, if price is hovering above the 50 EMA, it is considered possible bull or buy opportunity. If price is hovering below the 50, it is considered down or bearish or possibly sell opportunity. And that is really the simplicity of the 50 EMA. Why an EMA, not an SMA? SMA stands for simple moving average, while EMA stands for exponential moving average. It is that the EMA is a little smoother. On its own, it autocorrects what under the simple simple MA would be probably a few whipsaws. So it is a little bit smoother. What's the word I'm looking for? It levels out prices a little nicer, so that you have a little bit of a more accurate reflection of what price is really doing. So at this point in time, we have the 50 EMA in place. Price right now is sitting right around the EMA, deciding should it go up again because it had some downturn right here, or should it continue going down from here on because it had the previous bar close below the 50 EMA. This is anyone's guess at this point in time. Remember, no one, and I mean no one, can predict what price will do. So at this point in time, if you were to take this dynamic trading strategy with nothing more but the 50 EMA, we're sitting here guessing, and the best thing to do instead of guessing is waiting. When we get a few closed candles, then we can decide whether or not this may be a buy opportunity or it may be a sell opportunity. But of course, the 50 EMA by itself is not enough to make a solid decision. Prices can dip below and retrace, like for example right here, and this would not have been a profitable trade, whether you even if you would have taken it as a sell, because it bounced right back up to the line and it kind of hung here flat to eventually just, so at the very most here you might have broken even, but even that is debatable considering that the EMA is slightly downward here. So that's it. Obviously the trading on just the 50 EMA alone, while it is dynamic, is not enough. We need to add something to that. What we're going to do then next is we're going to add a second EMA. And again, we go to our indicator installation icon on MT4, we go to moving average, And this time we pick the 20. Again, exponential, no shift. On the close, we change the colors so that we can clearly see. I like the orchid color. I don't know why, but I do, so that's what I'll pick. We click on OK, and here we go. So now we have two dynamic indicators, the 20 and the 50 EMA. Again, remember, they're moving averages which automatically adjust to the changes in price. And that's exactly what dynamic trading is all about, automatically adjusting to market sentiment. Market sentiment being the trend, being momentum, and being volatility, in particularly these three. So now that we have the 20 EMA in place, we can clearly see that right here where the bars were bouncing up and down between over the 50 EMA, we're kind of stuck in between the 50 and the 20 EMA. By the way, I chose the 20 because also with professional traders, this is called crossover EMA strategy. The 20 EMA combined with the 50 EMA are excellent for that, for average entries. If you choose the 13 and 34, you get more signals, but you will also get more false signals. If another common pair is the 50 with the 100, but that is more long term because you'll get far fewer signals and it will take longer to build a crossover. So it is your choice which one you prefer, but the 20/50 EMA has proven to be an excellent combo that works very well for the 15, 30 minute, 1 hour, 4 hour charts. So as we're here now, we're clearly seeing that price is basically hanging between both the 50 EMA and the 20 EMA. All of a sudden, we must have had some kind of spike in volatility because of news or something, and all of a sudden, we have a massive bear candle. You don't react on a massive candle, bear or bull, because almost always these candles will reverse, not the candle itself, but the next candle or the next several candles that will be created after. And as you can see right here, that's somewhat what is happening. Bulls are trying to regain some of their territory back. Now, what is crucial to look for here is if the bulls are no longer able to get within what I call the death zone, and the death zone is where price hovers between both EMAs like here. It is really a stalemate. You don't do anything there. It is really just, nothing happening, not a decision making time thing. So you have to wait and see until price is either above the 20 EMA for a bull, or it is below the 20 EMA for a bearish indicator. Now, at this point in time, you see that we have price definitely jumping down very rapidly. And I know there is some news happening today. I don't remember if it has to do with interest rates or what. This may be a reflection of it. I don't know. But at this point in time, I'm not going to talk about that. The fact is, I am not doing anything here, even though price is well below the 50 EMA right now, because this is not the premise of how we trade a crossover. A crossover has to have the following conditions in place before you even consider a real trading opportunity. Number one, for a bearish entry or a sell position, the fast EMA, which is the EMA with the 20 period, must be crossed over. This is a crossover, by the way, here and here. Those are called crossovers. Must be below the 50 EMA or the slow moving moving average, and price itself must be below the 20 EMA as well. Only at that point will we consider a possible entry for a sell opportunity. The reverse is equally true for buy. Right here we had a crossover in the up direction. The fast EMA was above the slow EMA. Price went well above the fast EMA, telling us there's a possible bull entry or buy position. And sure enough, it went up for some time, and we would have had a nice little profitable position right here. So these are the premises of trading the MA crossover dynamically. And as you can tell, since we didn't have the 20 EMA move below the 50 EMA, these two bear candles, although they are large in size, went nowhere, and it again turned, as I had said prior, became a massive bull candle followed by yet another bull candle. At this point in time, that may indicate that we are probably heading up again or back into bullish territory, but we cannot make that decision just yet because this candle has a long tail, so sellers are still kind of trying to push their weight and holding on to quote-unquote territory. But this is how you trade dynamically the MA crossover using nothing but a standard 20 EMA exponential moving average combined with a standard 50 EMA or again 50 exponential moving average. In the next up and coming video, we will add an additional tool to this particular setup that will give us an even stronger signal whether or not we have a potential buy or sell opportunity. So stay tuned for that. This is Load with Black Bear Dog Training signing out now. I want to thank you for being here. I hope this was educational for you, and I'll see you in the next video. Until then, take care, and as always, God bless.